Hello, hello. How is everybody? Hey, Dolores. Thanks for sharing. Hi, Deborah. Nice to see you. Hi, Steph. Great to see you. And thank you for sharing. Kay, hello. Nice to see you. Thank you for sharing. Avril says, what a pleasure to be here tonight. Hi, everyone. Well, Carmen, I hope things are better for you. Hope things are getting better and that it is really a pleasure. Okay, so the topic for tonight is the big move by Jay Powell. The topic was originally suggested by a link that was sent to me by Lana Dell. Who sent me a Twitter thread. It was initiated by Denny Heck, who is the representative for the 10th Congressional District in Washington, and who has decided to step down from his post after the current session, so the seat is open, and there are progressives who are running for it and contending for it and who have a chance to win. So this would make the House delegation a bit more progressive. And one of them may even be a candidate for the squad. But what we're looking at here is something Denny Heck did, and I will now share the screen so you can begin to see that. He pushed on Jay Powell, but Jerome Powell, his name actually is. He's the chairman of the Federal Reserve Board. In other words, the head of the Fed, the same spot that was occupied by Alan Greenspan for so many years and by Paul Volcker, and then by Ben Bernanke and by Janet Yellen just before Jay Powell. Now, there's always been a rap against the Fed since the late 1970s. And the rap against the Fed has been that it uses wage increases on the part of workers as a signal to raise interest rates. The framework it was using was the Phillips Curve, the framework, which is a framework that says that there's a trade-off between the level of unemployment and the rise in the interest that is charged by the Fed for monetary policy. I shouldn't even put it in that way. There's a trade-off between the level of unemployment and inflation. And the tighter the employment market, which means, of course, the lower unemployment is, the higher wages are going to be, and the more danger we have of getting into a wage price spiral and having inflation. So the Fed in the late 1970s decided to preempt that because it was using that Phillips curve, a trade-off kind, a framework. And whenever the labor market was getting too tight, as one could see from where the wages were rising, that was a signal to the Fed that the labor market was getting too tight, therefore a signal to them that they should raise interest rates to try to choke off investment in new activities that would raise employment even higher, and that would then create even a tighter labor market, and shortly thereafter, inflation driven by higher wages. That was the framework they were using. That was the assumption they were making. It was a theoretical assumption. Okay, it was a theory, and they used the theory to guide them, and they raised interest rates. And they especially did this, a very famous situation in which they did this was in the stagflation of the 1970s, when towards the end of the 1970s, Paul Volcker just raised interest rates. And as the unions responded and as the labor market got tighter, he just raised interest rates more and more and more. And it seemed to be having very little effect. It wasn't choking off business investment. It wasn't choking off business activity. So he kept on raising interest rates until finally he got to a prime rate of something like 20%, if I recall correctly. I don't think it was a federal funds rate, okay, of 20%, but a prime rate, okay, the lending rate to your best business customers. That was raised to 20%. The federal funds rate was also fairly close to that level, but not as high as the prime rate. Anyway, finally, that did have the effect of choking off activity and creating a recession in the early 1980s that greeted the Reagan administration when they came into office. Well, Reagan got extremely lucky, and some of the initiatives of Jimmy Carter involving a deregulation of the natural gas industry began to take effect in as the Reagan administration went forward, 1981, 1982. By 1983, there was an oversupply, okay, of oil, which had actually been driving the inflation, the stagflation, okay, of that period. And the oversupply, okay, of oil caused a crash in the price of oil, and the rest of the economy followed. And Paul Volcker then decided that he was able to lower interest rates again, and he did. And by 1983, 1984, we had a booming economy, which accounted for the very good performance of Ronald Reagan in the 1984 election. There's a reason why Ronald Reagan was called the Teflon president. And that was one of the reasons. He got really, really lucky. He actually benefited from Jimmy Carter's policy long after Jimmy Carter was long gone from the presidency. So since then, it's been an article of faith among economists who are progressive that when the Fed raises interest rates, it's not good for business. It chokes off activity. And progressive economists have actually believed that for many years, and many of them still do. It's a very common view. And it was a view that was espoused by Denny Heck. And here he tweets, well, first I should give some background. The Federal Reserve finally decided that the Phillips Curve, which had been refuted time and again since the 1980s, in fact, was incorrect, that as a theoretical framework, it was bankrupt. And Jay Powell was probably the first chair of the Fed to actually admit this and to take it seriously, in spite of the fact that he's supposedly a conservative and was appointed by Donald Trump because of the bona fides he had as a conservative. It turned out, that from the standpoint, of the progressives, he is the one who abandons the orthodoxy of the Phillips Curve. Okay, and so let's look at Denny Heck's statement in this tweet, and then we'll put it in context. It says, "I've spent 8 years in Congress pressing Fed chairs. When does America get a raise? We can't afford another jobless recovery. Working Americans deserve to keep more of what they produce, and with today's at Federal Reserve decision, I am confident they will." And he made a statement just below. He says, quote, "Today's announcement from the Federal Reserve is a monumental victory for American workers. For 50 years, the gap between the haves and have-nots in America has been widening. This income inequality is rending the very social fabric of our nation." So far, so good, by the way. He's quite right. "Despite a legal mandate to achieve full employment, which was passed, by the way, in the Humphrey-Hawkins Act in 1979, for decades, the Federal Reserve has consistently raised rates as unemployment dropped, slamming the brakes on the economy just as tighter labor markets began to give workers the bargaining power to win pay increases." So that's the way Denny looked at what had been happening for 40 years. Quote again, "I spent nearly 8 years in Congress asking Fed chairs, from Bernanke to Powell, when does America get a raise?" Trying to get the Fed chairs to abandon the classical policy. "I have taken every opportunity to press for policy changes to more aggressively pursue wages and employment. We can't afford another jobless recovery, quote unquote. The workers' wages fall further and further behind." So that's the way that Denny Heck had been looking at this. And he says in this second tweet here, "Seriously, I've been at this for 8 years with at Financial Services Committee Democrats." That's the House Committee on Financial Services, the chairwoman of which is Maxine Waters of California. Okay. And Denny Heck then reveals, "For years I've been arguing the Fed should do more to boost wages. Today's interest rate cut is welcome news, and I commend Chair Jay Powell. I'm glad to see the Fed asking itself the question I've been asking all along, quote, when does America get a raise?" Then Denny Heck says, "I'd be remiss if I didn't applaud and thank at AOC for her relentless advocacy on this issue since joining at FSC Dems last year. She's been an incredible champion in pushing the Federal Reserve to do more for working Americans." There's a photo of Jay Powell, who delivered the Fed's had new message. Which was a rejection of what had been a consensus view of the relationship between the jobless rate and inflation. So previously, when the jobless rate got as low as it had been just before the pandemic, 3.6%, the Fed would clamp down by raising interest rates. Jay Powell did not do that. What he recently did is make it very clear that the Fed was no longer thinking along those lines. It was no longer assuming that when the jobless rate got too low, that we necessarily would have an inflation that it would have to start to fight. Okay. Now, the Phillips curve was closely associated with what's called the NIRU, the natural rate of uh, you know, what does NIRU stand for? The National Accelerating Inflation Rate of Unemployment. The non-accelerating inflation rate, okay, of unemployment. That assumed that there was a particular rate. There was a particular rate, okay, of unemployment below which unemployment could not go without triggering an accelerating rate of inflation. MMT economics has always rejected, okay, the reality of the NIRU. It's been associated with basically conservative economics and libertarian economics, and their support of the Phillips curve trade-off. What MMT has argued for a long time now is there's no such thing as a NIRU. There's no such thing, okay, as a NIRU. And as the empirical evidence has piled up over the years and unemployment rates have gone lower and lower, and inflation has failed to appear, the Fed finally had to accept the idea that there was no empirical data that could do anything except to reject the idea that the NIRU was real. So the NIRU and the Phillips curve are out at the Fed, and the idea that as unemployment goes lower, we have to see what happens. We have to see if there's a rise in wages and, in consequence, a rise in inflation, or if there's not. So you see that people who think they're on the progressive side, okay, are celebrating with this. And even though Denny Heck is establishment and has been challenged by real progressives in the past, AOC was working with him on this. And she says in her tweet, "Thank you, Denny Heck. It's been wonderful working on the Financial Services Committee with you." And there's one more reply in this thread by Dan Bianco. "Why not exempt the first 50K of income from payroll taxes for employers and employees and raise the income tax to make up for the revenue? Help workers and small businesses." That is not a suggestion I'm going to comment on here because it gets us off the topic, which is the change in Fed policy. But that's where the thread was taken. Joe Segal tweets, "The Fed's mandate is obsolete. Full employment but long ago stopped being tied to rising livable wages and a stable economy. The Fed should buy consumer debt, medical, school loan, and credit card debt to put cash in people's hands immediately." And there's a tweet by one Kajish, by Katajan, which is at, I'm not able to pronounce that, I'm sorry. When you seem to be missing, he or she says, is that the Federal Reserve is actually working against the interest of Americans by inflating asset prices, thereby increasing wealth inequality and destroying the savings of the lower and of the middle class. So this tweet reveals one of the trade-offs that some people are perceiving based on the low interest rates of the Fed. They consider that that is inflating asset prices because what happens is that people borrow money to buy assets, and there's a competitive demand in the market for assets greatly increasing, and that inflates the value of property. And so that's a counteracting factor in the market. Okay, not a tweeter 16 says, quote, speaking of AOC and showing a gif of her dance when she first was getting into Congress. Quote, she's been an incredible champion in pushing the Federal Reserve to do more for working Americans. And that was as AOC was becoming a star. I remember that. And then somebody says, I think it has to be said that if AOC didn't block Amazon from coming to Queens, the greatest city on earth could be hiring people so they stay rather than seeing them leave by the hundreds. Shame, shame, AOC. Well, that's another argument entirely. We're not going to go back to that argument anymore. It seems to me AOC did the right thing there, given the price the city was going to have to pay, okay, to get Amazon to invest as they were suggesting they were going to invest, and there were no guarantees they would invest that anyway. So I think AOC was right, but I'm not going to go into that. And somebody tweeted, she asked the Fed chair several key questions that Kudlow was enamored with and wants to discuss economic policy with her. Of course, a lot of her questions are motivated by a knowledge of MMT she carries with her. And then we have a bunch of tweets on subjects that are not related to the major theme. So anyway, I just wanted to start off by showing you that more clapping, supposedly for AOC. I don't know if it really was for AOC, but evidently it's from the Democratic convention. It can't be from the Democratic convention because nobody was wearing masks or social distancing. It must be from another Democratic convention. Anyway, that's it for that particular thread, but I wanted to do that as an introduction to the next article, which is by Eric Levitz from The Intelligencer, which is a segment, okay, of New York Magazine. And the title of the article is, In Historic Move, Fed Will No Longer Kill Jobs to Fight Phantom Inflation. Okay, and Eric Levitz is the author of that. Let me share that for you so you can see. Share the screen. Blah, 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 blah. So there we go. In a historic move, Fed will no longer kill jobs to fight phantom inflation. There's a picture of Jay Powell. And let's just go over it. It will clarify what I previously said. An historic break with decades of policy, the Federal Reserve announced Thursday. Yeah, it's been going on since the late 1970s, folks. It's historic. It's big news that it will no longer deliberately keep millions of Americans employed at all times. A central bank has a dual mandate to promote full employment and price stability. These two aims were long presumed to be in tension if unemployment fell too low, such that there was no slack in the labor market, i.e., no reserve of jobless workers for employers to draw on. Then workers would gain the upper hand on their bosses and demand wage gains in excess of their own productivity, which would force companies to raise the prices of their goods to keep up with their labor costs, which would then cause workers to demand still higher wages to keep up with prices in a vicious inflationary cycle. This seemed to be happening in the late 1970s, but it wasn't really being driven by a labor market that was too tight. It was being driven by oil prices. All the labor market was trying to do was to catch up with the oil prices. For this reason, the Fed defined full employment as an unemployment rate significantly above the level one would expect from mere job switching frictions. In other words, at that time it was thought that 3% represented true full employment, that there would always be 3%, at least due to job switching frictions in a tight labor market. But for a while, the Fed was operating with an idea that the NAIRU was at 5.5%. So they were aiming for an unemployment rate of 5.5%. A whole 2.5% of the labor force then was being unemployed or was trying to be unemployed by Fed policy. A full 2.5% above what was necessary for job switching frictions. Moreover, it isn't at all clear that 3% is necessary to allow a smooth job switching. It isn't even clear that 3%, is the lower limit. From the MMT point of view, the objective should be full employment, as defined by whether people who want a job can find one. And the MMT policy for facilitating this is to have a job guarantee for anyone who wants one. Anyway, going on with the article, when the labor market tightened beyond the level the Fed deemed conducive with price stability, it would start raising interest rates to choke off credit creation, slow growth in the money supply, and thus to deliberately keep Americans out of work, even if inflation had not yet exceeded its official target. As, for example, the Fed was often had a target of maybe 3%, or maybe 2%. But even though inflation wasn't going over the 2%, and the Fed was having trouble meeting its target of 2%, it might still be raising interest rates if it felt unemployment was getting too low. I mean, it did that under Bill Clinton. Unemployment had hit 3.8%, and the Fed was starting to tighten up on interest rates. This operating procedure had significant redistributive implications. The wealthy have far more to lose from inflation than they do from modest levels of unemployment. In fact, many business owners, they actually prefer for the U.S. economy not to achieve full employment, since workers tend to be less demanding when jobs are scarce. By contrast, the most vulnerable workers in the U.S., such as those with criminal records or little experience, will struggle to get a foothold in the labor market unless policymakers err on the side of letting unemployment fall too low. In the aftermath of the Great Recession, the inequity of the central bank's long-time prioritization of avoiding theoretical inflation over the certain unemployment of millions of workers became more conspicuous. The Fed's official inflation target is 2%, but for a variety of reasons, among them the tepid pace of the recovery and the weak bargaining power of American workers in age of trade union decline, price growth remained stubbornly below those levels, even as the central bank kept interest rates near zero. Nevertheless, despite the absence of any hint of excessive inflation, the Fed began raising interest rates in 2015 on the grounds that the U.S. could not sustain an official unemployment rate of below 5%, the NAIRU again, without triggering a wage price spiral. However, progressive economic policy wonks pushed back on this move, such as Dean Baker pushed very, very hard and has always believed that the Fed policy has had a deflationary effect on the economy and the labor market and is a major cause of inequality. Then, when a Republican president with a penchant for easy money came to power and the GOP's inflation hawks went dutifully silent, Trump's appointed Fed chair, Jerome Powell, otherwise known as Jay Powell, has adopted a more accommodative stance. And America proceeded to learn that its economy could not only abide a 3.6% unemployment rate without suffering runaway inflation, but that such a rate wasn't even sufficient to bring inflation to its target level of 2%. And the theorized hard trade-off between unemployment and price stability did not appear to exist, which meant that America's finest economic minds had been slowing growth and killing jobs for no good reason. For at least 35 years, maybe closer to 40, the finest economic minds had been wrong. It's good to note here that the institute that practices MMT at the University of Kansas City, Missouri, I should say the University of Missouri at Kansas City, sorry about that, is called the Center for Full Employment and Price Stability, because what MMT economists think is that full employment and price stability are perfectly capable of being realized if you have an economy that substitutes a job guarantee buffer stock for an unemployed buffer stock. That's what happens with the job guarantee program. In fact, under the MMT framework, the NAIRU framework is entirely replaced by the job guarantee framework. So going on with the article, these developments prompted the Fed to conduct a review of its monetary policy strategy. And on Thursday, Jerome Powell made the two conclusions of that review official. One, the Fed will no longer presume that it knows what the maximum level of employment in the U.S. economy is, and will therefore refrain from raising interest rates until there are clear signs of excessive inflation. And two, the Fed will not treat its 2% inflation target as a maximum, but rather as the average rate it wishes to promote over an extended period of time, which is to say, if inflation runs a bit low, okay, I should say a bit lower than that target for years on end, then the Fed will tolerate inflation a bit above that target for a few years after. In one sense, this announcement just formalizes the Fed's current approach and the fact that the central bank will tolerate higher than 2% inflation when it wasn't able to engineer such inflation during the post 2008 expansion, let alone during the current crisis, may seem trivial. But the policy does influence investor expectations and is likely to push the Federal Reserve into a more pro growth, pro employment stance at the margin. The next time inflation hawks call for rate hikes and 4% unemployment and tepid to moderate inflation, Powell's official policy will put them at a disadvantage. As significant as the rule itself might be, Powell's rationale for it acknowledges the maximization of employment as an objective with profound stakes for inequality and social justice. Speaking of what the Fed learned from its consultations with community and labor groups, Powell said Thursday the stronger labor market that prevailed before the pandemic was generating employment opportunities for many Americans who in the past had not have found jobs available. A clear takeaway from these events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. In its immediate concrete impacts, the Fed's policy is borderline negligible, but ideologically, it affirms a paradigm shift in how monetary policy is conceived at the elite level. Since the stagflation crisis of the 1970s, the dominant view of the Fed's role was as a check on the profligacy of our government's elected branches. Its primary job was to snuff out inflation before a spendthrift Congress sent it spiraling out of control. And it could do this by dispassionately identifying and targeting the natural rate of unemployment, that is to say, the NIRU. This view is now outmoded. In the wake of the 2008 crisis, Congress didn't impair national prosperity by indulging in too much deficit spending. It did so by tolerating too little. If there is a natural rate of unemployment, the Fed is manifestly incapable of identifying it, and in a context where labor lacks the capacity to extract significant wage gains, even when the labor market is tight, the Fed feels compelled to acknowledge that its policy decisions are not actually apolitical. There is no one universally optimal type of monetary policy, which is dictated by impartial data. All Fed policies are made by human beings in the middle of great uncertainty, and how the bank chooses to balance competing risks and imperatives will benefit some segments of society while hurting others. By acknowledging this reality, Powell has made it a bit easier for America's working class majority to prevent its ox from being gored. And that, is the Levitz article, which is a pretty good statement of the position of most of the progressive economists. Eric Levitz is not such an economist. He's a reporter, but he does a pretty good job of covering the economy and the views on the progressive side of the economics discipline. And he did that here in a very clear way, I think. So this article is a very useful article, especially as a supplement to the Twitter thread that we went over earlier. But let's look at another view, okay? Here's an article by Ed Harrison, The Policy World We Live In, okay, and its implications. Ed Harrison has a very broad background, okay, in economics, I believe he originally came from the Austrian world, okay, or the libertarian world, but he's been greatly influenced and greatly friendly to MMT at least since 2010. He's read a lot, okay, of MMT, and his perspectives on many things are very much in line, okay, with MMT. This is a blog post from his Substack site. And let me share this with you. I don't want to forget to share it. It's a good one. Okay, the title of it was written August 31st. The title of it is The Policy World We Live in and Its Implications. Yes, I have two related tweet storms this morning whose logic I want to flesh out a bit with you. These are tweet storms of his. They relate to the existing macro policy world we live in and how that affects outcomes. The long and short is that the outcomes are suboptimal, and I suspect the recent Fed policy shift will not change that. More detail below. Tweet store 1, the Phillips Curve. I'm going to try to make this post to make this mercifully brief. I'm thinking of it as a pseudo launching pad for a conversation I plan to have with Ash at Bennington on the Real Vision Daily Briefing today, and it continues a conversation we had around the Phillips Curve on Friday, and he links to that. Here's the gist. Thought bubble. When the Fed was raising rates in 2015, under the guise of inflation preemption, maybe it underestimated how much slack there was in the labor force. See this chart. And Ed has a chart there that he exhibits, that he links to. So, I'm not going to cover the chart, but remember, he goes on to say, remember when we had 3.5% unemployment in the U.S. and President Trump touted it as the greatest economy in the history of the world? Well, why was labor force participation dropping like a stone if everything was so good? Labor force participation is the percent of the potential labor force, adults, okay, of working age, who are actually participating in the labor force, who are actually working or who are officially unemployed, who are part of the unemployment statistics. That percentage is the labor force participation rate. He says when people are dropping out of the workforce in the millions, which means, by the way, that they're not counted in the unemployment statistics, he says, Ed, correctly, it's hard to say you have a tight labor market. And that's the graphic of what's happening to the labor force participation rate. You see, at one point it was nearly 67%, and now it had gone down to something like 63.5 before it precipitously dropped due to COVID. Now it's come up a little. Ed says, to my mind, this chart points to massive hidden unemployment, and it's policymakers' job to let the economy run hot. Let me just double check something. Let me give you the full view of this so it's a little larger for you. And it's policymakers' jobs to let the economy run hot until that hidden unemployment is revealed and eliminated. So Ed is saying it's not the unemployment rate itself that you should be looking at that counts so much. What you want to see, quote, what you want to see is increasing labor force participation. And we didn't get that. We did not get that. Okay. By the way, looking at that particular graphic, you see it was near 67% in the 1990s, the beginning of the 1990s. It went up even closer to 67% by 2000. But then it started dipping down, until in the jobless recovery of 2008, more and more people dropped out of the labor force until the labor force participation rate actually went down below 63%. It recovered a little bit during the Trump administration, but even at its height in the Trump administration, it was no more than 63.5%, a full 3% lower than it had been at its height. And then, of course, it collapsed in COVID. Okay. So Ed again says, what you want to see is increasing labor force participation. We didn't get that. We're on our way there. Labor force participation was stable from 2014 to 2020. But then the pandemic destroyed all of that. And now we have to rebuild from a much lower base of participation. Yeah, a really lower base of participation. And then Tweet Storm 2, entitled Perverse Policy. Here's the thing. If labor force participation is falling, you don't have a tight labor market. The two are almost mutually exclusive. And if you don't have a tight labor market, you aren't going to get robust wage growth. Absent an exogenous cost push shock, like the Arab oil embargo. Notice he talks about cost push inflation with the perspective, okay, of an MMTer, saying that the inflation of the 70s was due to the cost push shock, and I think he should have added, and how the Fed responded to that by raising continuously the interest rates. He asked the question, absent such a shock, how does inflation get embedded and spiral upwards then? It's not like wage earners, flush with newfound wage gains, are pushing up demands for goods and services, is it? If you don't have a tight labor market, that can't be the cause. That's what he's saying. He says, that's the world we've been living in for 2 or 3 decades. Yeah. 1990s, 2000, 2010s. And all along, the way the Fed has been trying to preempt the inflation bogeyman. Remember this quote, if we were not to withdraw accommodation, the risk would be that the economy would crash to a very, very low unemployment rate and generate inflation. He's saying a very, very low unemployment rate is a crash, Tight employment is a crash. Dudley said, quote, then the risk would be that we would have to slam on the brakes and the next stop would be a recession. That's what Bill Dudley, then the New York Fed president, was telling people. He was basically saying he was concerned that unemployment was getting too low. Strange? Well, his view was based on the economic framework from the Phillips Curve, where at very low unemployment rates, inflation shoots through the roof. The thinking is that there is always some frictional level of unemployment, which is why initial jobless claims never hit zero. And if you try to goose up the economy when we're at those levels, you end up bidding up demand above a restricted supply level, and the result is rising prices, aka inflation. That makes sense in the abstract, but here's where the perversity enters. First, maintaining policy to actively throw people out of work is what Bill Dudley wanted to do, and the Fed has done every business cycle. The point is to eyeball the unemployment rate, and if it gets too low, jack up the Fed's funds rate until unemployment increases and slows the economy down. The Fed thought you could get to 5.5% unemployment before its fear of inflation would cause it to hike rates. But the Fed has let unemployment drift even lower again and again without any pickup in inflation happening. They let the economy run, but they still ended up creating unemployment at the very end of every cycle in order to preempt inflation. What's more is that capacity utilization has been declining every single business cycle. Look at the numbers, and you can see since the 1970s, when they began to pursue this policy, the degree of utilization of our capacity to produce things has gradually decreased lower and lower until now, of course. With COVID, we're using very, very little of our capacity right now, only using 65% or 70%, when we used to use 90% of our capacity in the 1960s. We were using 90% of our capacity. Now we're only using 65% of our capacity. And Ed asks, does that look like an economy on the precipice of demand outstripping supply anytime in the last 30 years? Not to me, it doesn't. And so Fed policy simply entrenches secular stagnation and income inequality. That was the gist of a 2017 post I used as the basis for a second tweet storm. And here is his view expressed in his second tweet storm. When the Berlin Wall fell and China entered the global supply chain, we got a massive boost to industrial capacity available to Western firms. That meant global wage arbitrage, keeping both wage growth and domestic capacity utilization lower. It also acted to tamp down on consumer price inflation. The Fed, looking through this development, stuck to a Phillips Curve framework that had it preempting inflation time and again before inflation was a threat. And the result was the Fed snuffed out wage gains just as they were getting into gear, exacerbating income inequality. Meanwhile, Hyman Minsky's two-price system model was in full effect. Yes, globalization neutered inflation in the cost plus plus a markup the realm of goods and services. But inflation was not neutered in the quote prospective income stream price system for asset markets. In fact, letting the economy run encouraged more and more speculative and Ponzi borrowing as business cycles actually lengthened. So we have seen fantastic rises in asset prices, also known as asset price inflation, even as consumer price inflation has remained subdued. To my mind, this is all due to an over-reliance on monetary policy, to our asking central banks to do it all. So here's the guy who comes out of a background very, very favorable to central banks, now talking from a completely opposite point of view. Except when the economy enters free fall, central banks are the only game in town, and that has had very negative economic and political consequences. Nothing Jay Powell said last week in his Jackson Hole comments changes this. A catch-up average inflation targeting regime does not change the over-reliance on the Fed. The continued run-up in shares and junk bonds tells you that. All investors see are more valuable prospective income streams because the Fed has issued very dovish forward guidance. They're telling us rates will be zero for the foreseeable future. So we might as well go long duration and heavy on risk assets. This works for risk assets until it doesn't. Your guess is as good as mine as to when a repricing occurs. But if we double down on the Fed as the only game in town, we won't be fixing anything. We'll simply be doubled down on a broken policy regime. So what is he suggesting? Well, the truth is, what he's suggesting is that we need to rely much more on fiscal policy. And in the area of fiscal policy, he takes something much more compatible with the MMT view. There's one comment I have to make about all this, which I want to make before I go on, to another subject. That is, it isn't entirely obvious that when you raise interest rates, you are immediately going to cut off inflation. It isn't even obvious that you're going to immediately cut off the rise in wages. It depends on a lot of different factors, in the economy. Now, we have to remember that when you raise interest rates and investors buy treasury bonds, because the interest rates on treasury bonds is also higher because you're raising interest rates, that the interest you're gaining from higher interest rates, higher interest payouts on treasury bonds, that's putting more money into the economy because the Treasury Department is spending more on interest rates. Whether that is inflationary or not, and how inflationary it's going to be, depends on what business does with that interest rate money. But depending on how the interest rates actually go, like during the 1980s, they were maybe at 6% or 7% or something like that. You do 6% and 7% interest rates now on treasury debts. You're looking at what, 700 billion, 800 billion a year? That's a lot of money to put into the economy. So there are a lot of other factors involved. That's a stimulative effect. It's a simplistic idea to say that the minute you raise interest rates, it's going to cut off activity by business people. It may do that for a variety of psychological reasons and because of expectations and things like that. But there are a lot of factors involved in whether business activity will really be choked off, whether unemployment rates are going to rise higher, and whether that's going to result in a reduction, of wages. That process is really not as clean-cut as it seems to be. We have to remember that back in the 1970s, it took a lot for the Fed to kill inflation, because labor for a while was quite successful in getting wage increases. While the Fed, it was getting wage increases to take into account of rising prices. And the Fed's efforts to raise interest rates were not immediately cutting off business activity. Businessmen were still trying to make very high profits, and they were willing to pay higher prices to labor to make those profits, to sell those cars, to do other things in the latter part of the 1970s. Now, finally, Paul Volcker raised interest rates sufficiently high to choke off the whole thing, but he had to get the prime rates of 20%. We've never seen that. So all I'm saying is the context in the economy is very important in terms of evaluating whether you raise interest rates is really going to have the effect of choking off economic activity. Historically, that does seem to have been the case, but it might be tied to the contexts of the economy during those periods of time. So, I wanted to leave you with that message, but now I want to move to another topic entirely differently I want to share, and that is, once again, fatalities due to COVID. Okay, let's refresh this page since it's been open all day and it doesn't have the latest results on it. Let's see what we get now. Now that's going too far. So the latest figures are 189,964, which is probably the final figure we're going to get for the USA today. It is just short of 190,000. You're still hearing people talking about 180,000, right? You're almost 10,000 fatalities behind right now. We have also covered quite frequently the deaths per million statistic. Okay, the USA is now at 573 deaths per million, only 3 behind Sweden. And you'll notice over the last 2 or 3 weeks, we have been rapidly closing in on Sweden. However, Brazil has been beating us to it. They are now at 582 deaths per capita, 6 more than Sweden. And they're now very close to Italy. Italy is at 587. It has not been losing any more people quickly. In a day or two, Brazil will surpass Italy. We will probably take a few days more than that. We're still 14 behind Italy. We might take 5 days or so to pass Italy, but we will pass Italy in short order. We can see here that also Brazil is getting awfully close to Chile right now. It's been gaining on Chile. We've been gaining on Chile. We're now about 20 deaths per million behind Chile. So relative to us, the fatality rates in Chile have been going down. So we have to see what happens. But again, we're still among the highest in the world, not counting the 2 very small nations. We are 9th in the world. We're about to rise to 8th in the world in deaths per million. So that's it. Now, if you look at the reproduction rate of COVID, and we look at the latest reproduction rates here, if we go to the RT Live site, rt.live, we can see that, okay, COVID is spreading. The cases are increasing. when the reproduction rates are more than 1. There are 2 states here that are just at 1. DC, which is not yet a state actually, and Montana. Okay. Then we get to North Carolina, which is a bit over 1. So COVID is increasing. And then we enter the states where COVID is increasing faster than it had been. Pennsylvania is at 1.03. Indiana, 1.03. Okay, New York, 1.04. Now, for a long time, New York had been under 1. It's experiencing increase again. A lot of states that had been experiencing decreases in COVID are now getting to increases once again. South Dakota is now up at 1.33. It used to be much lower. Then it had the motorcycle rally in Sturgis. And there are a lot of new cases in Sturgis. Also, North Dakota has been increasing recently. That's because it's close to South Dakota, right? Iowa, not too far from North Dakota, and so on. New Jersey has gone up recently. Minnesota, I think it's a little down from where it was. But one thing about this particular graphic, one thing that's very convenient about this is you can look at it 2 weeks ago. Let me refresh it now. And you can see it doesn't look like there's been a heck of a lot of change in the last 2 weeks. If you look at 1 month ago, though, you can see that the spread statistics were generally lower across the United States. And there were fewer states, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 states where COVID was increasing 1 month ago. And what is that? 34 states, I'm including DC now, where COVID, was decreasing. Okay. And you can see that 1 month ago, Texas and California were fairly low at that time. Florida was fairly low. Prior to that, we've been hearing a lot about things really reproducing rapidly in Texas, in Florida. But even 1 month ago, that had changed. If we look at 2 months ago, we can see many more states were increasing COVID. There were probably more states where it was increasing 2 months ago than right now. 3 months ago, when the reopening first occurred in June, you saw a real mess, with Montana having a rate even of 1.49. Notice Arizona was at 1.19 then. They were having a real crisis. Texas was having a real crisis. And if I recall correctly, Florida was having a real crisis too, but I don't know where that figure is right now. Let's see if we can find it. Virginia was doing well then. It's not doing well now. It's over 1 now. So if you look at it over time, you sort of get this situation. Oh, here's Florida. It was quite high, 1.36 3 months ago. It's now brought things under control. In terms of the latest, Florida's at 0.92. It's one of the best in the country. Texas is at 0.83. But at that time, there were a lot of New England states that were very low. Okay, and look at Arizona, which was having a terrible time. It's at 0.92. So COVID, okay, is going down. So what we're doing is we're seeing a pattern. States go up for a while, they go down for a while as the governments respond and things are brought more under control. As they decline, the economies loosen up in those states and they start increasing again, and the states start losing control of COVID. This is very cyclic. It's very cyclic because of the ebb and flow of government action in each of the states. There's no coherent pattern across all the states because there's no coherent policy across all the states. So COVID lingers and lingers and lingers, and the deaths keep on coming. They keep on coming. So you can see about half the states now are having declining COVID, and about half the states are having increasing COVID. 3 months ago, many more states were having increasing COVID. 1 month ago, though, many more states were having declining COVID than we are having now. So there aren't consistent trends here. There's an ebb, okay, and there's a flow. Overall, the deaths are continuing at a high level. In recent days, the fatality chart shows us running over 1,000 deaths a day, generally speaking. Yesterday, 1,090. 2 days ago, 1,164. If we go 3 days ago, we probably get back to the weekend. Usually on Sunday, the fatality rates are lower. That's probably a reporting artifact. But we're getting an average of 1,000 a day. That's been going on for some time now. That's roughly 30,000 a month. That's why the models are continuing to forecast that probably by election time, we will be around 250,000 fatalities. We're now at about 190,000 soon. And so that's what we have to face. Those are the wages that come from electing Donald Trump. Sorry, I mistakenly turned off my StreamYard I don't think the stream is ended, though. You look like you're still there, as far as I can tell. Uh, I'm still not seeing you back on Facebook, but I suspect you are there. StreamYard seems to indicate that you're still there. Yes, you are still there, and I'm not at the beginning of my stream, so that's good. So you only missed a few seconds. You didn't miss anything I said. I am now ready to take your comments. And as always, I appreciate them. So, Evelina said, isn't that right? And for some reason, your early comments are not showing up. You probably had a good many before 9:42, but except for the ones I saw at the beginning, I wasn't seeing much. I'm only seeing the ones from 9:42 on. Evelyn says, isn't that right? And Avril says, and hope Powell doesn't get fired. Avril says, very clear. Evelina says to Avril, we need more than just him, though. Steve says, sorry, distracted tonight. Donald J. Trump had a memo to defund protest cities, including D.C., where an 18-year-old was just killed by cops. And says he was unarmed, shot in the back. Carmen says, so much injustice. Steve says, protests have ensued. 2 weapons were found on scene. Keep us informed on that, Steve, if you can. That's horrible. Steve Gonzo just sent you a friend request. He did? I thought Steve Gonzo was a friend. But anyway, I'll be happy to uh, make him a friend if he's not a friend. I certainly thought he was. Carmen says, speaking of COVID, he is in, Steve Gonzo is in my messenger. If he wasn't a friend, how can he be in my messenger? I'm sending him these messages all the time. Carmen says, speaking of COVID, Sturgis attendant died, age 60, Dwayne Johnson. His wife and 2 little girls, 2 and 4, are fighting it too. That's incredible. Incredible. Carmen says, I knew that was a mess waiting to happen. Notice people came from all over the country. Lara says, over 200 cases linked to Sturgis. Kay says, there will be many more. Carmen says, I don't want it to be as such. Kay says, me neither, but people are stupid about it. Avril said, I've started back on D3. I didn't realize you'd stopped. Kay says, I take that and vitamin C and B complex and vitamin E every day. Carmen says, you can't trust the CDC or state or reported numbers anymore. Stephanie says, good night, everyone. The weather has been horrible nonstop. I did chair almost 50 plus groups. I'll be here tomorrow. Hugs. Thank you for coming, Stephanie. And Kay says, night, Stephanie Smith Bayudi. And Deborah says, night, Steph. Carmen says, the Midwest is set to be hit hard soon. Avril says, we can't trust the numbers coming from Death Santis. Ohio House GOP are trying to impeach GOP Governor DeWine because he's trying to follow the science. Shake my head, I hate Ohio. Carmen says, vicious cycle. Biden has mentioned he'd be willing to shut the nation down to snuff this out. Not so with the orange fascists. Dale Weaver said, it's all good here. Carmen says, just got back. What did you say about the DT and COVID stream interrupted? Kay says, I sent him a request, Joe. And Steve says, Ford Fisher is streaming DC protest on the Twitter. I'm Joe's friend, by the way, soon to be Kay's too, D. Yeah, I know you were my friend, Steve. Okay, so uh, okay, I don't have any more comments. The last one was at 10:23, so I've caught up. I am going to briefly share the screen again to remind you of my promo. Did I actually share the screen? No. Did I cut off the broadcast again? No. Sorry. I don't know what I'm doing tonight. I think I'm a little on the tired side tonight because I've been getting up early the last 2 days because I've had car troubles. Annoying. Very annoying. Anyway, I wanted to show you the promo one more time. If you have any more questions or comments, I'll be happy to answer them. I'll give you a couple of minutes to ask me something. If not, I am going to call it a night. And OK says she sent him a request. I'm going to call it a night, and I'll see you all tomorrow. Thank you for coming. It's been great. Everybody sleep well and have a good night.